All right, let's switch gear now to one of Nigeria's lenders, Polaris Bank, which is back in the news for some good reasons after surviving a near state of collapse in 2018. The bank, which is a reincarnation of one of Nigeria's premier banks, Afribank, has released its first IFRS-compliant financial statement for 2019, which reflects a bottom line of 27 billion naira as top line hits 150 billion naira. Joining me now to look at this bank's earnings is the Managing Director and Chief Executive Officer of Cowrie Asset Management Limited, Mr. Johnson Chukwu. Good morning, Mr. Chukwu. Thanks for speaking with us on Business Morning. Tell us, what's your general assessment of the performance of Polaris Bank in 2019 as revealed in the recently released annual financial statement?
Thank you, BC, for having me. For us in Cowrie, we consider the performance of Polaris Bank in 2019 as rising from the ashes of debt. And because what the kind of figures they reported was beyond anybody's imagination. Nobody could have imagined that the bank, which was an offshoot of a dead bank, could come out and report a profit of about 27 billion naira in each first full years of operation. And if you look at all the parameters, the bank is actually punching beyond its weight in terms of efficiency. In all the efficiency parameters, when you compare Polaris Bank performance in 2019 to that of Tier 2 group members, you realize that apart from Stanbic IBTC, Polaris Bank beat all the Tier 2 banks in terms of efficiency.
What were the key highlights of the results?
Well, the key highlights are, if you look at the net interest margin, it recorded one of the highest interest margin in the industry at 11.5%. In terms of cost to income ratio, at 59%, that is one of the best we saw in the industry in 2019, even better than the Tier 1 banks. In terms of return on equity, you saw a return on equity that was also higher than most, about 28%, higher than most of the other banks. I mean, return on equity about 28% higher than most other banks in the industry. And then we even have a return on asset of 2.3%, which is also higher than most of the banks in the industry. And when you compare this to Tier 2 banks, where they actually belong to, you also realize that, as I mentioned earlier, apart from Stanbic IBTC that could compete with it in terms of efficiency, and when you measure some of these efficiency parameters, it actually beats the likes of FCMB, Wema Bank, and Fidelity Bank in terms of efficiency. So I think whatever the management is doing to achieve that level of efficiency, because going forward, it will all be about cost leadership in the industry. And for a bank that's actually positioned itself as a cost leader, that bank management has actually done greatly to prepare for the next phase of competition.
Does this result in any way come to you as a surprise, given that this was the first full year of the new Polaris Bank's operations, which inherited some assets and liabilities of the former Sky Bank?
Absolutely. If you look at the fact that it came from the ashes of a bank that was the central bank had to revoke its license because of increasing insolvency and lack of liquidity, and for that bank to come back and make a profit in the first full year of operation, about 27 billion, came as a surprise to me. I didn't expect the bank would come out with such a strong statement in terms of performance. One would have expected that it would take the bank about 4 or 5 years, given the very harsh competitive environment that we are currently witnessing in the banking industry. So I think it must have not just come as a surprise to me, it must also have come as a surprise to anybody who is a keen observer of the banking industry.
What would you say that the bank did differently to achieve this milestone?
I think it has to do with its cost management. I did mention the fact that it has one of the highest net interest margin of 11%, 11.5%. In terms of cost to revenue ratio at 59%, that's also exceptionally very good. It simply means that in terms of operating costs, it has kept its operating costs very low. And of course, that has dovetailed in a very strong return on equity of about 28%. So the key thing that the bank did exceptionally well is that it has focused on managing its costs. And it has also been a bank that has been driven by conservative risk asset orientation. You observe that its risk asset portfolio is far below the regulatory minimum of 65%. It's about 22%. Of course, there's a saying in Africa that once bitten, twice here. We know that major problems that the phobia that is Skybank had was a very bullish and aggressive risk asset creation that led to high incidence of number of loans. As it stands today, even Polaris Bank is still dealing with some of those legacy problems. If you look at its non-performing loans and loan expense, which is not coming from current loans, obviously coming from legacy loans, you will observe why you can understand why management decided to be risk averse. But that may obviously benefit it given the unstable macroeconomic environment today that could lead to an increase in non-performing loans. So, in summary, one would say that the bank was exceptional in its cost management.
What was the role of the CBN and AMCON in this remarkable turnaround story? And what does this say about regulatory interventions in troubled financial institutions?
I think this is one of the good stories coming from the regulatory intervention in the banking industry. If you remember, Skybank had total deposits of about 750 billion naira. If the central bank and AMCON had not stepped in to save it from liquidation, and it was handed over to NDIC to liquidate, then you would have had about 750 billion naira of depositors' funds would have been lost. At that point, Skybank was a systemically important bank, and that would have led to loss of confidence in the banking industry, could have maybe possibly pulled down some other banks. So this intervention has not only helped to stabilize, financial system stability was clearly one of the winners in the central bank and AMCON intervention in Skybank. And the model is something that should be documented. And if the need arises in future, probably the central bank should pull out that model and try to deploy it in such other instances where a bank is in distress.
Tell us, Mr. Chukwu, what happens to the 786 billion naira injected by the CBN into the bank?
Well, it's going to be a long-term investment as it stands today. And ultimately, you're going to see, since the bank has turned profit and also generating positive cash flow, in due time, the bank will gradually pay back that amount to the central bank. Because what the concerns we all had was that if you inject money to save a bank and the bank continues to make losses, it's digging deeper the hole that was previously created. But now that the bank has turned the corner and could make in a single year as much as 27 billion naira, you can see clearly with such trajectory, the bank will in not distant future be able to pay back the central bank the amount the central bank has given it to support the bank at the onset of its commencement of business.
Today is Workers' Day now. How will Polaris Bank uphold this record performance with staff retention in view of COVID-19?
You know, I did say earlier that the bank is a cost leader. And when I looked at the cost-to-income ratio, it simply means the bank has kept a slim personnel and operating structure to have a 59% cost-to-income ratio. The only bank in that tier group that actually surpassed that was Islamic Capital that had a 50% cost-to-revenue ratio. So it then means that the bank may not have so much flesh as to cut as a result of the coronavirus engendered economic crisis. We've already seen a couple of financial institutions, other institutions thinking of how to reduce their costs in terms of personnel costs. But when a bank that has been a cost leader, it may not have so much baggage that it has to drastically reduce its personnel cost. So I think the bank has already remained a slim operator, and it may just have to work further, strengthen that. I don't see the bank having to right size materially. Of course, there may be some people that here and there that may be laggards, and since such bank is not ready to carry any unnecessary overhead or any free rider, and I expect that the management led by Adetiku will ever allow anybody to be a free rider in an institution he's running, because somebody I know very well. So in that wise, if there's a free rider, it may be an opportunity for you to disembark such person. But beyond that, I think the bank has kept a relatively slim operating structure and may not have any material need to go into massive cost cutting.
But what's next for Polaris Bank now? What should we expect from the bank going forward?
I think what the bank needs to do is focus on, one, its area of strength, which is in cost leadership, and two, or expand its service delivery in terms of riding on fintech. As it stands today, the coronavirus crisis has actually pushed the world to come to realize that you really need fintech for those in the financial services industry to drive your businesses. So, and that will also help the bank expand its non-interest income, because with a slowing global economy, the appetite for risk asset creation will be actually likely going to moderate. And so most banks will actually look at other alternative sources of income and non-interest income sources, which the bank is not quite strong in, might be an area the bank will have to focus on. I expect they will have to improve on their fintech adoption and use it to drive non-interest income.
Now, with these impressive figures now, is that to say that Polaris Bank is actually rightful still as a CBN mandated AMCON to actually pursue that purpose in 2018?
Yeah, clearly. I mean, they say sometimes they say the end justifies the means. This one is beyond the end justifies the means. We can actually analyze what the bank did excellently well, which had mentioned the issue of cost optimization and cost containment and efficiency. So the central bank decision to actually close the chapter of the legacy Sky Bank and create a new bank in form of Polaris Bank has turned out to be a master stroke, because I did mention that the profit that the bank made is far beyond anybody's expectation. It's better than most of its contemporaries in terms of tier 2 banks. And the bank has a strong liquidity as it stands today, a strong deposit base, about 857 billion naira in deposit, a total asset size of about 1.16 trillion naira, has returned to become a systemically important bank. So I think one has to commend Central Bank and also commend AMCON for the innovative method they adopted in managing or chaperoning Sky Bank into a Polaris Bank that is beginning to create value for all stakeholders.
Please hold on to your thoughts, Mr. Chukwu. We'll continue this conversation in just a moment, plus an opening call to London. Please stay with us. Welcome back. We still have the Managing Director and Chief Executive Officer of Carry Assets Management, Mr. Johnson Chukwu, with us. Mr. Chukwu, tell us, what's the outlook for the banking industry generally in the context of the COVID-19 pandemic and the economic crisis?
I believe that the banking industry, just like most industries in the world, are going to go through some difficulties. We should see a decline in the top line in terms of revenue. Because as the global economy contracts, then the business opportunities for them to lend and generate revenue from those lending activities will also contract. Then I also expect the banking industry to actually focus on what, for instance, a bank like Polaris Bank and the likes of Stanbic IBTC have done: cost optimization. You have to now focus on your bottom line, and for you to do that, you have to look at, how do I manage my costs in the period when I can't grow my revenue substantially. Of course, there is a training video by one of the managing directors of one of the Nigerian banks, talking about cost optimization going forward. So I think the industry globally, not just in Nigeria, will go through some level of weight shedding to keep their bottom line strong. I also expect that the industry will have to adopt technology. This lockdown has actually exposed everybody that, look, technology is the way to go. Currently, I'm interviewing from my sitting room in Lagos, and it's quite clear. I mean, the pictures are quite clear. And I expect in my organization, we'll be having meetings at regular intervals from our individual homes, and we have been working remotely from our homes. So the banking industry will also have to fully adopt that. The banking industry was actually leader in fintech, but now it's time for that to be a competitive advantage. You need to really up your standard in terms of adoption of technology to drive service delivery. So you're going to see a situation where the banks may not need so much of human capital in terms of number, but more of technology to provide services to their customers. So I expect in the next couple of years, 1 or 2 years, the industry to go some difficulties in terms of revenue growth, but then the focus will now be on how to manage your costs, as well as how do I adopt technology to possibly displace some of the things I needed so many people to do. Any bank that is not taking that direction might find it difficult to survive in the long run.
Carry Asset Management, Mr. Johnson Chukwu, thanks for speaking with us on Business Morning.